Okay, hi everyone. Just in this slideshow, I'm just going to go through a range of different topics for your test. Probably go for about 15 minutes, and hopefully it'll give you a bit of help for tomorrow, but also a bit of revision on some of the things we have discussed in class. So first of all, factors of production. Make sure you know what the four factors of production are. So these are basically the things we use to make goods and services or to generate income. So you've got land, labor, capital, and entrepreneurs. Land, natural resources, labor are basically the human effort used in the production process. So individuals, plumbers, builders, fashion designers, etc., etc. Then you've got your capital resources. The key thing with capital resources is they're man-made resources. So things like computers, trucks, ladders, tools, etc. And basically what they do is they help us to make goods and services. So they combine along with labor resources to help us to produce goods and services. Entrepreneurs are those that run companies and generate a profit. So unlike labor resources who generate a wage, they generate a profit. It's important also, how we allocate resources in Australia, so how we answer the three economic questions, which is what to produce, how to produce, and for whom to produce. What to produce is basically, how do we choose what goods and services are produced? And in Australia, because we're mainly a market economy, it's mainly based on demand and supply. So when there's more demand for products, we produce more of them because it will generate higher profits, and that producers do that because they're self-interested. The government also steps in, though, because as we know, there are products with positive and negative externalities. So they will ban certain undesirable products that are bad for our living standards and also provide subsidies or support to try and encourage us to provide things like education, healthcare, and things like that. How to produce? Are we going to be labour or capital intensive? They generally choose whatever's most cost effective, but the government can get involved with things like minimum wages, which encourage firms that are more capital intensive because it will cost them more to hire labour. And for who to produce, basically who gets access to the goods and services produced. And in Australia, it's mainly those who have the most skills or the most talent. They generate, if they've got skills that are in demand, they generate higher wages. But then the government steps in and provides support, so things like welfare and public housing and stuff to also provide support to people as well. The visible hand of the market. So basically, what that means is in a free market, there's this unobservable force which coordinates demand and supply to reach equilibrium. So the invisible hand is basically saying is if we leave the free market to its own devices, producers will produce what consumers demand. It doesn't mean that everyone will get their demands met. It doesn't mean that everyone's wants and needs will be met, but the producers will generally produce what consumers want because that will allow them to generate a profit. So it's all about the producers produce what consumers want because that allows them to generate a profit. I'll skip through this. If you don't have a read through this, you don't need to know the exact steps, but be mindful of the impact that different shifts can have on price and quantity. So if demand shifts to the right, then we'll end up with a higher price and we'll end up selling more of a product. If demand shifts left, we'll end up selling at a lower price and selling less of a product. If supply shifts to the right, we will sell more of the product. So that's like if we invest in new technology or better machinery or capital or whatever, we'll end up selling a higher quantity but at a lower price because firms will end up with a surplus once they get better at producing things. So say it's like a good season for producing apples, we'll end up with a surplus of apples, so they'll be forced to lower their prices. And if supply shifts left, we end up with a higher price but a lower quantity sold of that particular product. Also be aware of things like positive and negative externalities. So positive externalities are products that have third-party benefits or benefits for people outside of the transaction. So a good example would be something like education, where it's underallocated in the free market because producers don't consider those third-party benefits. So things like the fact that when people get an education, they're more likely to pay more tax in the future, or they're more likely to make the workforce more productive, or they're less likely to be involved in crimes. So these are the third-party benefits when consumers and producers get an education. So the government will step in and provide things like public schools. They'll subsidise private schools. They'll give people HEX help, which is like a discount on university, and you have to pay it back until you're working. And things like minimum school leaving ages to make sure we get the right amount of education in society. Okay, moving on to the public companies. So some key words when you're talking about public companies, you've got things like dividends and capital gains. So dividends occur when companies make a profit. They might just give you a random payment out of that profits, where capital gains is specifically money that businesses give to that you earn, when your share price increases. When you buy a share for a low price and sell it for a high price, you make what we call a capital gain. And that's what that means. Advantages and disadvantages of public companies. So public companies, basically they have limited liability. And what that means, if you invest in a public company, you can only lose the value of your share. So they can't force you to sell your own private assets, your house, your car, any luxury goods you own. That's a good thing. It also allows companies to raise a lot of capital because they can get investors from other areas. But the weaknesses are that they must comply with a lot of legal requirements. You don't always get as much of a say once your company goes public because everyone owns it, or it's owned by a range of different people. It's also got large setup costs, so it often costs a lot of money to set up a public company. As I mentioned before, limited liability means shareholders, when you invest in a company, you can only lose the value of your shares, so you can't be forced to sell your assets or your land. Whereas unlimited liability means that if you're running a business and that business goes poorly, you can be forced to sell off your own private assets or your own car and your own house to some extent. It just means that you've got more of a risk when you have unlimited liability. Real GDP and nominal GDP. So real GDP occurs when there's been an increase in the value of production after we remove the effects of inflation. So, and nominal GDP uses current prices, so it's before you remove the effects of inflation. So essentially, if we looked at what we did in class, nominal GDP is calculated by just multiplying price times output in each year. So in year one, it'd be 10 times 50 plus 10 times 25 plus 10 times 25, so it'd be 1,000. And in year two, it would be 10 times 55 plus 12 times 25 plus 9 times 30, which I think worked out to be 1,120. So nominal GDP uses the current prices, but if we want to see whether we've actually increased our output, we have to use the prices from the first year. So to work out real GDP in the second year, we would times the outputs in year two by the prices in year one to get us a better indication of whether we produced more, the value of production has increased after we take into account price increases. Wealth versus income. Okay, wealth, basically all the things you own at a particular point in time. So basically it includes the value of your house, any land you own, your superannuation, cars, minus your debts, so any credit card debt, mortgages, etc., etc. Whereas income is like a yearly transaction. So it's what you earn in a particular period. So it's like the money you earn from your job, so labor or so like your wage or your salary. So some examples of things that might be included in both wealth, be like cars, shares, boats, superannuation, any properties you own, any land, etc., etc. Whereas income would be things that are like a yearly flow, so like salaries, wages. You might get commission from your job, interest on your bank account. If you're on transfer income, you might get the welfare or the pension, capital gains on your shares. So if your share price increases in value, that's income, but the actual value of your shares is wealth. So, for example, in a given year, if your shares go from $10 to $15 and you've got 1,000 shares, then the difference, the increase, can be classified as part of your income. You sell your shares, but the total amount you own is your wealth. So just when you're calculating the Gini coefficient, you can do that for both income and wealth. These are the steps. You might want to have a read through. I'm not going to go through them all now, but there's some steps when you're calculating the Gini coefficient to be aware of. The other thing is different types of loans. So you've got secured and unsecured loans. Secured loans mean that if you're basically got some form of collateral. So if you default on that loan, so say it's like a mortgage, if you default on that loan, the bank can get your house. So it's secured against the house, which means that they get an asset if you fail on that loan. Whereas an unsecured loan means the banks don't have access to anything if you fail. So like a credit card loan, the banks can't seize anything if you fail to pay it. So it's more risky for the banks, and therefore they charge you a higher interest rate. Progressive, proportional, and regressive taxes, make sure you know the differences. So progressive means the rate of tax increases the more you earn. Um, so proportional means the rate stays the same, and regressive means that high income earners pay less or a lower rate than high income earners. So this one, the rate increases, this one, the rate stays the same, and this one, the rate decreases the more you earn. If you look at these figures here, this is what you're earning on the left-hand side, and this is how much tax you paid. You can see that you're paying 2,000 on 20,000, 4,000 on 40,000, and 6,000 on 60,000. So you're paying a flat 10% of what you earn, which means that's a proportional tax because the rate stays the same. Still pay more tax if you earn more, but the rate stays the same. And same with the second one. Oh, sorry, same with this one here. The rate staying the same because you're paying a flat rate of 5%. With country two, the rate's increasing because you pay 2,000 on the first 20,000, then you pay 3,000 on the next 20,000, and 4,000 on the next 20,000. So the rate is increasing. So you can see here, this person's paying 9,000 on their earnings of 60,000, which is around, well, it's over 10%, whereas 2,000 on 20,000 is 10%. So the rate is increasing as you go along. That's this one. These two here are a bit different. The rate actually goes down the more you earn. So this one you're paying 2,000 on 20,000, which is 10%, but then you only pay another 700 on your next 20,000 and 500 on the next 20,000. So the percentage that you're paying goes down, so it's regressive. And you can see here that someone earning 60,000 would only pay 3,200 tax, which means it's just above 5%, which means they're actually paying a lower rate. Couple of things with the labour market. Have a read through this slide. I don't have time to go through it now, but know some features of strong and weak labour markets. Make sure you know the definitions of unemployed and the unemployment rate. So unemployed means you're actively seeking work, but you can't find a job, where unemployment rate measures the number of percentage of people in the labour force who can't find work. So the percentage of people, all the people looking, can't find a job at the current time. Employed persons, to be employed, you have to be working over an hour a week. That's all. You've got to be aged over 15. It also employed if you're on strike or you're ill at the current time, but you've still got a job. Whereas unemployed means that you're actively looking for work, you're aged over 15, or you might have been like sacked and you're waiting to start a new job. You have to be actively looking for work and not have a job to be unemployed. The labour force includes everyone who's unemployed, so actively looking for work, plus all those who are actually working. So the total size of the labour force is the employed plus the unemployed. People that aren't in the labour force are people like retirees, people that still at school can't be in the labour force. If you're working for charity and not looking for a job, then you're not part of the labour force. Prisoners, anyone who's a homemaker, so decides to stay at home and not look for work. Anyone who's not actively seeking work. Those who leave their job to travel, as long as if they're actually leaving their job and they don't have employment. And people who've given up looking for work are also included. So make sure you have a read through those as well. The unemployment rate calculates the number of unemployed as a percentage of everyone in the labour force. So all the people that are looking for work or have a job, what percentage are unemployed? All the people that want to be in the labour force, what percentage can't find work? So it tells us what proportion of everyone looking for work can't find work. The participation rate is the employed plus the unemployed, so everyone in the labour force, as a percentage of everyone over the age of 15. So the participation rate tells us what percentage of people over 15 are actually looking for work and want a job, as opposed to the unemployment rate who tells us what percentage of people looking for a job can't find work. You also need to know the different types of unemployment. So make sure you do a bit of a recap on seasonal and structural. Have a look at the unemployment video to know the different types of unemployment. When you're calculating inflation, make sure you're aware of how to calculate it. So you basically do the price at the end minus the price at the start divided by the price at the start times by 100. So if it's for June 2015, it'd be 108.4 minus 106.2 divided by 106.2 times 100. These figures, what they basically mean is that how much prices have increased since 2012. So a figure of 122 means prices have gone up by 22% since 2012. To calculate inflation for the quarter, it would be 122 minus 118 divided by 118. To do it for the year, for March, would be 122 minus 115, the March figure last year, divided by 115 times 100. We're going to skip that because I'm a bit short of time. The last thing I want to touch on is the federal budget. So every year the government brings out a federal budget, and basically what that means is the difference between what they're collecting in revenue and what they're spending in a given year. If the government runs a budget surplus, that means government revenue exceeds expenditure in that year, and if they run a deficit, it means expenditure exceeded revenue. So you've got different types of revenue. The main form of revenue of individual income tax, and you've got a range of other taxes like company tax and GST and excise taxes. If the government's collecting more in all this stuff, so they collect around $400 billion a year, then they're spending in like education and defence and healthcare and welfare, then they're running a budget surplus. If we run a budget surplus, that means we're earning more than we're spending in a given year, and that allows us to reduce our government debt. So the government debt is all the money that the government owns at a particular point in time. If the government earns more than they spend, then they can start to reduce some of that debt. But if we run a budget deficit, then we're going to increase the size of that debt. Even if the deficit gets smaller, so if you look at these 2 years, the deficit went from 37 billion to 27 billion, government debt will still increase because we're still spending more than we're earning. So we actually have to reduce we actually have to run a surplus to reduce government debt. And last thing, make sure you're aware of some of the things in the coronavirus package. So we talked about the $750 JobKeeper package. They're giving $550 to people on unemployment benefits. Just be aware of some policies that were part of this year's budget. Obviously, the $750 budget is for people that get kept on that they don't get sacked. Thanks.